can you talk to me a little bit about capital gains tax, Kristen? This is something I know very little about, so I'm interested to know how that works.
Yeah, so it's another tax. I like the tax lady, aren't I?
You are, you're like the bearer of great news today.
So capital gains tax is basically payable on disposal of an asset. So for the purposes of this discussion, it would be if you were to sell a property. And in general, it's the difference between the amount that you paid for the property and the amount that you sell it for. That difference is the gain. Now you can reduce the gain by taking into account renovations and money that has been spent on the property. Straightforward decoration you can't really use, but for example, if you put a third floor into a two-storey house or you built an extension, the cost of that can reduce the amount of gain that you have made. However, that gain then is assessed against your annual capital gains tax allowance, which at the moment is £11,300. So if the gain is more than that amount, you would have to pay tax on it.
Okay. That's good to know. Those profits are going down, down, down.
Absolutely.
But that shows again one of the experts we were talking to in finance was saying about how important it is, to look at your own individual circumstances and make sure that you're looking at cash flow strategies so that you're protected and you've got a bit coming in that's going to see you through these kind of turbulent times.
Yeah. I was actually told recently, I was talking to an accountant recently, because normally with capital gains tax what would happen is you would declare it on your self-assessment return if you were an individual with a gain and declare that to HMRC after the end of the tax year in which the gain has fell. The difference actually now with buy-to-let properties is you're expected to declare that return within 3 months of it happening, or declare the gain within 3 months of it happening, in which case the chances are then you're going to be getting a bill to pay if you are liable for capital gains tax. So for example, if an investor in stocks and shares, for example, made a gain, they wouldn't be declaring that gain until the end of the tax year in which it fell. It's different for a buy-to-let property or property investment. It has to be declared much earlier.
Wow.
So the other difference with capital gains tax for properties, we've actually just had a CGT reduction. So for most other forms of asset, the basic rate of capital gains is charged at 10%. If you're a higher rate taxpayer, it would be charged at 20%. But actually that is a reduction on what it used to be, which was 18% and 28% respectively, which has been kept in force if the gain has come from selling a property.
Okay. Totally fascinating stuff, and it makes me think so much about the due diligence process for new investors that are coming into the marketplace and people that are excited to come into buy-to-let who might not be aware of all of these other considerations now, that it's not the same marketplace as it was maybe 5 or 10 years ago, and you can really get yourself into some, not just financial trouble, but legal trouble and all sorts of trouble if you're not properly educated about these types of subjects.
Yeah, absolutely. It's very true that it's a different landscape, very, very different. But I think one of the biggest things to be aware of is not always taking the I can do it myself approach. I've worked for 20 years in financial services. There's a lot of clients who I know are very astute in business. They have a plan and they know what they want to do. And I think if you're, a property investor or developer, you generally see a vision and you know where you want to get to. But it's really important not to always think I'll just do it myself, because a quick Google search is going to throw up a lot of different facts and figures. Not all of them are going to be absolutely current. The thing about tax and regulation is they can change with any budget that comes in, and I think in this tax year we're about to have 3. You know, so these things change all the time, and I think that you know, if you fall foul of HMRC on reporting, then obviously that's going to cause you problems. But if you don't budget in your plan to pay potentially CGT, extra stamp duty, those sorts of things, then it can quickly turn a project from being on budget to out of budget.
It's a loss. Wow, it's absolutely fascinating.
I think you're the only person who would say tax is fascinating, but that's okay.
It is so interesting to learn from a different angle. I obviously work in a niche area of property, so this is so interesting because you're hearing so many arguments and so much confusion. So it is for me very fascinating to sit here and get the information from the horse's mouth and get that the correct information too.
Thank you for watching this video. If you like this content and you'd like to join our free online property training course, we've got a link for it on this page. And in there we cover a range of different property strategies to help you get started, either building a long-term property portfolio or creating a cash-flowing property business. We also look at ways to increase your return on investment with any of the properties you're maybe considering. And we also have a couple of cheat sheets and downloadable documents in there as well. Simply click on the link to join the free training course today.